Okay, good morning, everybody. Welcome to the tax sections program on corporate separations that are virtually inevitable. Learn the complex tax rules of how to do them tax-free. Before we begin, we have a couple of housekeeping announcements. You will receive your MCLE certificate shortly after the program. Your certificate will also be stored in BHBA Plus, our members-only community. Please take a moment to complete the survey that is included with your certificate. And I want to thank our tax section sponsors. The tax section is sponsored by Hochman, Salkin, Tasher, and Perez. The Hochman, Salkin, Tasher, Perez PC advantage is experience, an eye for innovation, and a genuine dedication to clients, their families, and their business. In addition to their national practice in civil tax and criminal tax controversies and related litigation in federal and state courts, the firm is also active and successful in handling non-tax matters such as business and estate planning for high net worth individuals and closely held businesses, together with white-collar defense and commercial disputes. And now we're going to move on to our program. I just want to invite you. I'm Michelle Weiss. I'm the tax section chair. And I want to introduce our presenter today, Stephen Mahaley, who's a senior attorney at KFB Rice LLP. Mr. Mahaley is a certified specialist in taxation law and a certified specialist in estate planning, probate, and trust law. He has been specializing in the field of domestic and international business and tax law for more than 35 years. He has been a member of international law firms, accounting firms, and boutique tax law firms. He represents domestic and foreign privately held U.S. companies and high net worth U.S. and foreign clients and their families in outbound and inbound transactions, focusing on structuring and implementing income, estate, and succession plans to minimize U.S. and foreign income and transfer taxes. He also represents clients in international and domestic tax controversy. Also, our presenter, Steve, has asked to please put all of your questions in the Q&A. We have a lot of material to cover today, and he plans to address questions at the end of the program. So Steve, take us away. Thank you.
Thank you very much, Michelle. I think we should start on page 3, which has the table of contents as to what we will cover. And I list there 15 items, and basically, you will see, starting with items 5 through 10, those cover the principal requirements to qualify under Section 355 of the Internal Revenue Code as a tax-free separation of a corporation. And then on the next page, let's see, you see the remainder of the table of contents, where I have a number of pages at the back of the material, which I've highlighted some of the key terms of the code itself, which is fairly lengthy, and the regulations, which are even more, are actually quite voluminous, but have many good examples, which I will try to cover somewhat, which should be of use whenever anyone would want to find some guidance. I should say that there are a lot of issues involving various sub-issues regarding Section 355 that are unclear. And the IRS has not been very helpful because they don't give rulings anymore for many years now on many of these sub-issues, such as what is a good corporate business purpose for doing the spin-off or split up or split off. And so what this means is that often attorneys will have to make the analysis to advise the client as to whether they will qualify or not. And sometimes it's not entirely clear. And of course, well, this can also lead to the possibility of better fees because it requires more analysis and risk, if you will, in giving an opinion that will be avoid penalties. So moving on to page 5. So we're talking about corporate separations. as opposed to partnership separations. As you may know, with a partnership, it's much easier to get in or out of a partnership tax-free. Of course, that you want to still has to be careful because there are still traps. But with a corporation, a C corporation particularly, separating the shareholders and from the business is tax-free is very difficult. In fact, there's a very famous saying, which probably most of you have heard, maybe in law school, that where I think it's by the famous Professor Bitker, who said corporate taxation is like he compares it to a lobster trap, namely that it's easy to enter, difficult to lie in, and painful to get out. So that's what we're trying to do, figure out how you can get out of a corporation, splitting up, separating, without being subject to tax. Normally, of course, if you sell your interest, the corporation sells its assets, it will result in a double tax. And if the tax-free 355 transaction would fail to meet one of the tests on audit, well, then of course it could be a disaster. It could be a deemed sale. So it's extremely important that all of the tests are carefully analyzed, and one can come to a comfortable conclusion that there will be no tax. So on page 5, I list some of the situations where corporate separations arise. I entitled my presentation that corporate separations are virtually inevitable. I think that especially is true in family corporations. Sooner or later, the second generation or the third generation, family members are not going to be able to get along, and one of them is, or more of them are going to want to get out. And how can you do that without triggering tax is what this presentation is about. So as I list on page 5, there's the situations where corporate separations can come into play is when shareholders no longer agree on the direction of a corporation, family business succession planning issues. Some family members may not want to be really involved in the business. Shareholders who want to insulate different corporate divisions or from liabilities of another part of the business. Corporations that want to give certain key employees an interest in one of the divisions. And sometimes corporations want to consolidate certain assets, not all of the assets, and distribute or sell off some of the assets prior to doing a spin-off. That's generally common with larger corporations. And as I mentioned, if one is not fully aware of all the rules and traps, the consequences could be very grave, namely the transaction will be fully taxable. Moving on to page 6, I have to apologize. These numbers are not quite correct. I originally had the tax rates from prior tax rates from 2017. So let's take a scenario where we have a simple scenario. We have a C Corp and it owns assets with fair market value of 100 and adjusted basis of 40. So there's a $60 built-in gain. So if we can't qualify or we make a mistake and don't meet all the requirements of a tax-free separation, well, the result could be that if the sale of the assets would be subject to the 21% corporate tax rate, and that's if it's a $60 gain, that means $12.60 of tax. And then if it's sold for 100, that means your dividends would be $87.40, on which you could be subject to a 37% tax rate if it's not qualified dividends, which would result in an extra $32.33 of tax. So the combined tax is almost $45, which of course is what we want to save by qualifying under Section 355. And then if we are dealing with an S Corp, Well, of course, it only has one level of tax. So if we have the same facts, the $60 of gain would be subject to, let's say, 37% flow-through tax, individual tax rate, which is $22.20. There'd be no corporate level tax. And so you can see that there'll be $22.20 of tax, which is 1/2 roughly of C Corp. So this is particularly relevant to C Corp, but also to S Corp, because obviously we don't want to pay any tax when we do a tax-free separation. So when we talk about Section 355 and tax-free separations, there's really three types. One is called spin-offs, and that can be pro rata or non-pro rata. Basically, it's when the distributing corporation creates or already has a pre-existing controlled corporation, and it spins the shares off to the shareholders of the distributing corporation. No shares of the distributing corporation are extinguished. It's just a spin-off. Another type of transaction is let me see here. Well, here's a spin-off actually. So you can see the shareholders, and this D is the distributing corporation. It either creates or already owns a pre-existing controlled corporation. It spins it off pro rata in this case, and the shareholders end up owning equal interests in both the distributing and the controlled corporation. And if it meets all the other requirements, it would be tax-free. Another type of transaction is a split off. So this is where, same scenario, we have a distributing and a controlled corporation, but in this scenario, one shareholder ends up owning, let's say, all or some or most of one of the of either the distributing or the controlled corporation, and the other shareholder or shareholders own a disproportionate portion, let's say, of the other entity. And then we have the third type of separation, a split up. And here you can see the scenario where we have distributing, and let's suppose it has two controlled subsidiaries. So, and when I put shareholders there, it could be multiple shareholders, obviously. So this diagram could have 3 or 4 or however many shareholders. And rather than each shareholder could end up owning a percentage of any one of these controlled corporations. And the distributing corporation is liquidated in a split up. Okay, so moving on, as I mentioned, the tax effects can be, well, let me back up. It's not necessarily true when you do it, if you qualify for Section 355 transaction, that it will be completely tax-free, because there are so-called boot, which is generally like when cash is transferred to a shareholder, that could be treated, that could be taxable, even though the spin-off of the shares would be qualified for a tax-free treatment under Section 355. In other words, the aspect of the spin-off or split up that's tax-free is the transfer of the shares. But if the value of the shares that are transferred to the shareholders are not equal or proportionate to their proportionate interests, well, and one shareholder gets more than another or ends up getting cash rather than stock, well, the shareholder that gets cash is getting boot, or it doesn't necessarily have to be cash, it can be non-stock property, will be taxable on that. There are also special rules under Section 355, under Section 355D, and Section 355E, which are basically anti-avoidance rules, which will still trigger tax, even though the transaction might qualify as a tax-free transaction, otherwise under the basic rules. And then the taxation of these boot is different whether it's a spin-off, depending on whether it's a spin-off or a split-off or a split-up, which you can see there at the bottom. Moving on. Okay, so when you do a Section 355 transaction, you either already have a distributing and a controlled entity, or you have a distributing entity and you drop down assets that you want to spin off into a controlled entity, which will be spun off. When you do that, when you drop down assets into a controlled entity, the earnings and profits of the distributing corporation have to be allocated between the distributing corporation and the controlled corporation based on the proportionate value of the fair market assets of the distributing corporation or the controlled corporation, or it can also be done on the basis also on the proportion of the basis of the assets that are transferred. Now, the net operating losses, if there's any losses, they will not be allocated. They will remain with the distributing corporation, or if there's already pre-existing controlled corporation. So now this is the key to determining whether one could qualify for a 355 transaction. And we have to be able to jump through all of these hurdles, or jump over all of these hurdles, to be able to qualify for tax-free treatment. So the first one, the transaction involves a transfer of stock of a controlled corporation. Well, I've already mentioned that. So if there's not a controlled corporation, the existing corporation can drop down assets into a controlled corporation and spin those off or split them off. And we'll talk about that more a little later. The distributing corporation must transfer at least control of the subsidiary corporation. And we'll get into what control means a little bit later. 3, the transaction cannot be principally a, quote, device for the distribution of earnings and profits of the distributing or the controlled corporation. And there are a lot of rules about this, as facts and circumstances, and one has to be, and there are certain factors that are kind of considered to be a, quote, device, and certain factors are considered not to be a device. But basically, one has to look at all the facts and circumstances in order to make that determination. The 4th hurdle that has to be jumped over is there must be a corporate business purpose for doing the spinoff. And this is perhaps the most important factor and quite complicated. And we'll get it, and there are a lot of examples in the regs and also court cases on what constitutes a valid corporate business purpose. And 5, both the distributing and the controlled corporations must be engaged in the active conduct of a trade or business. And we'll get into what constitutes active trade or business, and also for what time period. And 6, there must be continuity of proprietary interest. Well, that basically means that the shareholders or of the distributing corporation, one of them at least, must continue to have a significant interest in the controlled entity that's spun off. And we'll get into that a little bit more as we go on. And then there must be a continuity of business enterprise. Of course, you cannot just simply spin it off and sell it shortly thereafter. Okay, so now we address the issue of whether you can get guidance from the IRS. And as I mentioned, it used to be in 1996, the IRS came out with, I think it was a revenue procedure in 1996. Sorry, I wrote it down somewhere. I don't recall, 1996-10, I think, had very, very lengthy rules about how to submit an application for a private letter ruling covering all of these factors and what the IRS required you to answer. But unfortunately, that's ability to get letter rulings ceased around 2003. And the IRS didn't want to deal with this issue because it was too time consuming and too factual. So ever since, we have had to try to, tax advisors have had to figure out whether a transaction will really qualify. And it is possible, there is this Rev Proc 2013-32, which does say that the IRS will not give rulings on whether the transaction qualifies for non-recognition treatment under 355, even though there may be significant issues. However, going to page 16, it is possible to get rulings on specific individual issues if they're significant. However, not on issues like whether you have a good business purpose or whether the transaction constitutes a device for bailing out earnings. So there are a lot of issues that you really cannot get the IRS to opine on, and that one will have to make that determination to advise a client. Yes, so as I say here, you cannot get any comfort rulings anymore from the IRS, and the policies and procedures are changing. They often change. In fact, I believe that the IRS just came out with a new pilot program. There's a Rev Proc 2022, I have it somewhere, where you can get an expedited PLR in, I think, 12 weeks instead of 6 to 9 months. Whether it applies to 355 transactions, I couldn't see that, but it's something to consider, because it is possible to get a ruling on sometimes on certain aspects of a 355 transaction, just not the entire, and not a number of the very significant issues. Yes, so we have, I mentioned this Rev Proc 2003, and I also mentioned this Rev Proc 2013. So if you want to look at this in more depth, as to what issues you might be able to get a PLR on, this will give you guidance. Okay, so the first major hurdle is that you need a business purpose for doing the spinoff, and the business purpose must be for both the distributing corporation and the controlled corporation. And this second bullet point is taken from the regs, this language about there must be a business purpose for not only the drop down of the assets to the controlled entity, and also for but there also must be a business purpose for the distribution. So you will see in the regs, there will be, there's multiple examples, but there's an example where a business has two divisions. I think it was candy and toy businesses. And they wanted to do a spinoff of one of the businesses, drop down the candy business and distribute it out to the shareholders. And the IRS said that they want to do that to protect one of the businesses from liabilities of the other business. And the IRS said, no, that won't qualify for tax-free treatment, because one, you drop down the assets of one of the businesses, that already insulates that business from the liabilities of the other business. So there is no business purpose for this spinoff of the controlled entity. And so this is one of those traps for the unwary. One has to be careful about whether there's a business purpose for both the drop down and the spinoff for both entities. And of course, the famous Gregory versus Hellring case that everyone's heard of, it involved, in fact, a spinoff type of split off type of transaction, actually. And it, I believe was allowed. And let's see. So that case had to do with business purpose also, and I believe it was permitted. Oh, here is the reference at the bottom to the Rev Proc 96-30. While it's no longer effective, it is a very good place to see how the IRS and what the IRS is looking for. And it has a lot of valuable information as to what is a good business purpose and when are you doing something that could be deemed to be a device to bail out earnings, et cetera. So I highly recommend that everyone who's considering doing a tax-free separation, look at Ref Proc 9630, Appendix A, because it has a lot of valuable information and relevant information still. So here are a number of examples of what constitutes a good business purpose for doing a spinoff. So I think I alluded previously, if there's a key employee who one wants to incentivize to keep, and the business purposes, obviously, to keep the business running. Without this employee, the business would not succeed, then that would constitute a good business purpose for doing a spin-off or split off or whatever. If the spin-off would result in cost savings to the company, for instance, let's say they could refund, if they do a spin-off and they're separated from the other business, and they could get a lower interest rate on their loans because they segregated, that obviously would be a good business purpose. Any kind of benefit to the corporation by doing the spinoff would constitute a good business purpose. There could be regulatory issues, there could be labor issues, all of those would be a good business purpose for doing a spinoff. Here is an example. A has two active trader businesses, a fishing business and a newspaper business. In an effort to separate the businesses to protect them from creditor risk, A contributes the fishing business to a controlled entity and then distributes that controlled entity to the shareholders. Is there a business purpose? Well, as I said before, if the purpose could have been accomplished in a tax-free manner without actually doing the distribution or the spinoff, and it wouldn't be, this alternative method would not be expensive or impractical, then there is no business purpose and you couldn't qualify for under Section 355. If businesses were protected by mere separation of businesses via drop down, then again, no business purpose to do the distribution. So that I'm just reiterating what I said before. Now we get to the second major factor, which is whether the spinoff or split off or separation is really kind of a disguised device to distribute out earnings and profits. So basically, this rule is to prohibit the bailout of a corporation's earnings and profits, which normally would be, dividends, taxed as ordinary income. But if you spin it off, then you can sell the stock of the spun off controlled corporation for a capital gain. And the IRS, of course, wants to prevent that. As I mentioned before, the determination of this factor is done on a facts and circumstances basis. They look at all the facts and circumstances. So even though you may have certain factors that are deemed here to be not a device, and certain factors that are deemed to be device, they are not necessarily conclusive. You have to look at all the factors, all the facts and circumstances, I'm sorry. So examples of factors that are considered or deemed not to be a device are if the distribution is treated as a redemption, then it's less likely to be considered a device. If the company is a publicly traded company and there are no 5% shareholders, less likely to be considered a device to bail out earnings. If the company has no earnings and profits, well, of course, it's not going to be considered to be a device. And if you have a good business purpose for doing the distribution, that will be a good factor for deeming it not to be a device. Examples of factors that are deemed to be doing the spinoff as a device to bail out earnings would be if the distribution, if the stock of the controlled entity is done on a pro rata basis, or if there is a subsequent taxable sale of this spun off controlled entity not too long after the spinoff. And I'll get into that a little bit more later, especially if it's pursuant to a prearranged agreement that would be very strong evidence of a device. But even if it's not, even if there's a subsequent sale, even if it's not pursuant to a prearrangement, that would still be evidence of a device. And another negative factor indicating that the IRS could deem this to be a device to bail out earnings is if the assets that are spun off consist a large amount of liquid type of assets. Getting on to the next factors that the client would need to pass would be that the controlled entity that is being separated or spun off or split off, et cetera, the distributing entity must control that entity, which means they must own at least 80% of the vote and 80% of the value of the shares of all classes. And those shares and that control, that 80% control, cannot be acquired within the 5 years prior to the distribution. In other words, those shares have to have been owned for at least 5 years by the distributing entity. However, of course, if you're dropping down assets into a new controlled entity, the new controlled entity will be considered to have been in existence for the time period that the distributing entity owned the shares, the assets that had dropped down. So that is in effect an exception. There's another exception, which I will get to right now. Well, not yet, actually. So there are some special rules where, let's say, a distributing entity doesn't quite meet the 80% control requirement. So if one recapitalizes the distributing entity to be able to meet the 80% control test, that is possible, but there are special anti-abuse rules. And also there are exceptions where one can reduce the ownership below the 80% control test. So if that would be a factor in the transaction, one should know that there are various special rules dealing with the 80% control issue, but that isn't a requirement. The next rule that has to be met is that both the distributing and controlled entities must be engaged in the active conduct of a trade or business, and if there is a drop down of assets or stock, let's say, the test is that substantially all of those assets or stock or securities must also be engaged in a trade or business, and substantially all means 90% of gross assets. If we are talking about a corporation that owns partnership interests, the rules provide that there's a look through the partnership interest to the underlying assets of the partnership. And of course, one obvious issue is, well, what about if there's a lot of, let's say, passive type assets? When is there too much passive assets so that it's no longer considered to be an active trade or business? And there are tricky rules about that, which, as I mentioned here at the very bottom, the active conduct, that means that the corporation must actually be engaged in performing the active trade or business. It cannot be like a holding entity, and it cannot contract out the performance of those services to an independent contractor. The corporation and its employees must actually perform the active trade or business. And so that can be relevant, let's say, for businesses that own real estate. If the owners of the real estate are leasing it out, but they are not actually doing the lease work, they are hiring independent contractors to do that, that will not qualify as an active trade or business. The engaging in the active trader conduct of a trader business must be done for at least 5 years. So there's a 5-year requirement. If the business has not been conducted for at least 5 years, well, then you're not going to qualify. There is an exception for assets that meet the so-called expansion doctrine. So if the business has been in place for 5 years, but there have been certain assets that have been acquired in operation for less than 5 years, those assets will still qualify for tax-free treatment if they are deemed to be a, quote, expansion of the existing business. And the regulations have various examples and of what it constitutes an expansion. And I think I have that too on the next page, the expansion doctrine. So if the assets that are purchased within 5 years change the character of the business too much, then it will not qualify under the expansion doctrine exception to the 5-year active trader business rule. And but the cases are pretty favorable to taxpayers. So for instance, there's this revenue ruling 2003-38, where a retail shoe business expanded its business by creating a website to sell shoes. Even though that website was not in existence for 5 years, it was not deemed to defeat qualifying for Section 355. If a business is an automobile dealership and it expands into another type of selling a different type of car, that's considered an expansion, and the second line of automobile dealership will not have to have been in business for 5 years to qualify for the tax-free treatment. And here in the third hypo, which is a case from 1965, you can see that the business was doing various different kinds of related activities, and all of those were considered to be an expansion of the business, and therefore, even though some of the aspects of the business were not in existence for 5 years, the entire business qualified for tax-free treatment. Okay, so now the question is, well, what percentage of the business must be actually engaged in, be an active trader business as opposed to a passive trader business? And the rules here are, there's some case law on this, and it's a bit vague. I don't think there's any hard and fast rule, but I would say 50% at least should be active, although there is even lower thresholds possible. But this is something that one has to be very careful about if there's a fair amount of passive type investments. Okay, the next threshold requirement that has to be met is that the shareholders of the distributing corporation, there must be at least one or more of the shareholders before the spin-off or split off who will continue to be having an interest in the distributing and or controlled entity that's spun off. And there again, there is no bright line test for this, but there's some case law, and it seems to be quite clear that if at least one of the shareholders retains a 50% interest in the business that's spun off, that will qualify for 355 treatment. If there's a shareholder that's a new shareholder in the spun off business that owns more than 50%, then it's getting questionable. There is some case law, I believe, or authority that has allowed a transaction to qualify for 355 tax-free treatment, even though the shareholder of the spun-off business owned more than the majority of the spun-off business, but you're getting into dangerous territory if you go that far. And then the next requirement is that the business be continued. So obviously, the IRS would not like it if there's a spinoff and not too long after the spinoff, the business would be sold or discontinued. So one has to continue the business enterprise of both the distributing and the controlled entities. Yeah, well, this is a special type of transaction. I don't think we need to really harp on it too much. But the point here is that there are a lot of detailed rules. And so depending on all the facts and circumstances, one has to be very careful to make sure that you don't trip up on any type of rule in the regulations or in a court or perhaps in a court case. Now, Section 355D is a special rule, which is a sort of maybe what you might call anti-abuse rule. And it basically will treat a transaction, what the IRS would consider a certain type of transaction as a disguised device, if you will. And so it applies if there's a person that requires at least 50% of the distributing or controlled corporation before the spinoff is done by purchase. So this is very specific, by purchase, not by gift, which could be significant. For instance, if you do a gift, it's not going to fall under this rule. During the 5-year period before the spinoff, this would not qualify for 355 under the special rule. And it doesn't matter what the intent of the taxpayer is, whether they had a good intent or not. So just this is kind of a strict liability rule, if you will. And so one has to be aware of this, that if there's a shareholder that acquires 50% of either the distributing or the controlled corporation before the distribution is made by purchase during that 5-year window prior to the spinoff, it will not qualify. So as it said, it prevents disguised sales of C corporate stock, and the distributing corporation will have to recognize gain if a person holds 50% or more of either the distributing or the controlled entity stock after the distribution. Okay, and as I said, if the 50% stock is acquired within 5 years of the spinoff, that is a negative factor. Then we have another anti-abuse rule under Section 355E, which applies when there's one or more persons. Remember, 355D applied if there's a person. This is one or more persons, requires at least 50% again of the distributing or controlled entity before or as a part of or after the distribution. Remember, 355D only applies if it's 50% is acquired before, within the 5 years before the spinoff. This is before, during, or after, pursuant to a plan, quote unquote. Then again, you won't qualify for tax-free treatment. And the key words there is pursuant to plan. It would mean any kind of prearrangement or deemed prearranged plan. So intent here is very relevant, whereas under 355D, which we just discussed, intent is not relevant. It's just a strict liability type of rule. So the facts and circumstances falling into 355E are important. as I mentioned, it applies if the distribution is part of a plan or series of related transactions pursuant to which one or more persons acquired directly or indirectly 50% or more by vote or value of the stock of either of the distributing or the controlled entity. And in that case, it will not be tax-free, and the distributing corporation will recognize gain on the distribution of the controlled shares of the controlled entity. Then we have another anti-abuse rule under Section 355G, so-called disqualified investment corporation rule. So this applies when the business has a lot of cash or passive liquid type of assets. And so it says that tax-free Section 355 treatment would not apply if immediately after the spin-off or split-off, either the distributing or the controlled entity is a so-called disqualified investment corporation, and any person owns 50% by vote or value, and the 318 attribution rules apply, meaning any kind of direct family member, or a greater than 50% interest in the disqualified investment corporation. But only if that person did not hold such an interest in the disqualified investment corporation immediately before the transaction. So what is disqualified investment corporation? It's when the distributing or controlled entity its assets consist of at least 2/3 or more the fair market value of those assets of investment type assets, quote unquote, such as cash and stocks and certain partnership interests and debt, et cetera. So one has to be careful when there is a significant amount of liquid type assets that you will not qualify for tax-free treatment. Now, there are certain exceptions to this if the assets are used in the active conduct of a lending, banking, or insurance business, or if you're in the active brokerage business, securities brokerage business. So now we have a couple examples of scenarios that one might come across or something similar. So let's suppose that there's A, B, and C, A, Bill, and Chris, and they inherited stock in C Corporation from their parents, and the corporation owns 3 industrial properties, and Abe is managing the corporation along with family real estate and earns a salary. One of the other siblings is not involved too much, and the third one is a ne'er-do-well, and the 2 siblings A and B want to operate the inherited business, but the third sibling is in litigation with them over the inheritance of their parents' estate in general. Not that uncommon of a situation. So what can a separation be done on a tax-free basis? So can the corporation drop down one of these 3 industrial properties to a controlled entity, New Corp here, and then spin it off to C or Chris here in exchange for his stock in the inherited company? Well, we have to run the gamut of all of these tests. Is it a device to bail out? Well, first of all, I think we have to start out, is there a business purpose for doing this? And that's very critical. It's not a shareholder business purpose. It has to be a corporate business purpose. What is the corporate business purpose for doing this separation? And if one could prove or have evidence that if Chris were in a shareholder of the corporation, that he would be so divisive and block the corporation from being able to operate, then the separation, the spinoff would qualify. There would be a valid corporate business purpose for doing this tax on a tax-free basis. But if he only owns 1/3 of the shares and he really has no input or power over the corporation, and the two other shareholders own 2/3, then I don't think it's going to be easy to qualify for a 355 transaction, tax-free transaction. So one has to really dig deeper into whether one can meet the valid corporate business purpose test. And then, of course, there are all the other tests that one has to also meet. Is this possibly a device to bail out earnings and profits? Doesn't look like it, because he's going to be getting one of the industrial properties as opposed to a high amount of liquid funds. But anyway, this is the kind of analysis that one has to get. Also, at the last paragraph there, you can see it says, assume that the industrial property to be spun off is worth $5 million. Well, this example doesn't say what's the total value of this corporation. If it's 20 million and he's only getting 5 million, well, then he's giving up, or maybe, in other words, an appraisal needs to be done to make sure that the value is actually equal to his interest. Otherwise, there could be a deemed gift, possibly by the other brothers or vice versa. So there could be other issues other tax issues that need to be considered here. Second example, Abe and Bill own Green Giant, a C Corp, which has several garden supply operations. And a separate partnership, Abe and Bill own the land on which the business operates. They've been happily in business for 4 decades, so they've met the 5-year actor-trader business test. I forgot to mention in the prior example, they inherited the business, so they would not necessarily have met the 5-year actor-trader business, but I believe it's tacked on in an inheritance situation. And then that's also true for if there's a gift of an interest, the actor-trader business is tacked on. However, they are now in their 70s and their children are also in the business. Do they not like the prospects of all of the cousins working together? Can Green Giant contribute 50% of the locations to subsidiary controlled entity Green Giant 2 and distribute those shares to Bill in exchange for stock in Green Giant, leaving Abe as the sole owner? Well, there again, we have an issue about, does this qualify? Is there a valid, from a business purpose perspective, is there a valid corporate business reason to do this? It says that Abe and Bill are getting along, so it doesn't look like there's any real reason to do this from a corporate perspective. This is a purely personal issue about an inheritance and how the future generation will get along in running the business, or what the preference is of Abe and Bill. So again, this is a fairly complicated situation and not so clear that it would qualify. Further facts would need to be created or elicited to determine whether the company would really not be able to function properly if the cousins got involved. So this, again, is a fairly common situation. That's why I entitled my presentation that sooner or later it's virtually inevitable that a C Corp is going to, a shareholder is going to want to separate. And how can you do that? Can you qualify or not on a tax-free basis? As I mentioned at the outset, because it's not really possible to get a private letter ruling anymore on the entire transaction or much of it, tax advisors are going to have to make these determinations on all of these various factors. And this is just a sample engagement. Of course, the amounts are fictitious. It depends on the complexity and the amounts involved, obviously. But the point is that there are a number of issues that we just went through that need to be analyzed, and any one of those or multiple of those could be complicated, and it might require giving a letter to protect the client at least from penalties should the IRS contest it, or actually giving an opinion letter. which could be good fees for advisors. Here I have a copy of the code, and I've highlighted some of the key terms that one will want to take a look at. I'm not going to go through the entire code, but as you can see, 355 is quite lengthy, quite detailed, and this is just the code. The regs are voluminous. And I've here attached a number of sections of the code dealing with the corporate business purpose. And as you can see, there are a number of examples which are helpful. So in this case, because there was a petroleum, a corporation in the petroleum business, and I believe there's an antitrust litigation, they were required to divest their business. So obviously that qualified as a valid business purpose reason for doing the spin-off or split off. In this next one, you will see down toward the bottom there, it says the word coextensive. So they're distinguishing between a corporate business purpose for doing the spin-off and a shareholder business purpose. And sometimes they can be, quote, coextensive. And that can get very tricky, whether a coextensive business purpose between shareholder and corporation will qualify or not for Section 355 tax-free treatment. There is an example here. This is a company that owns a jewelry business and a furniture business, and they want to split it up. So it's okay. So again, it's talking about whether they have a valid corporate business purpose for doing this transaction, but it also has a shareholder business purpose. So it seems like they are able to justify this as a tax-free business separation, because the separation they can prove that it will enhance the proficiency of both businesses, or at least one of the businesses. There's this case called Bondi, where Mr. and Mrs. Bondi were going through a divorce, and Mr. Bondi, they owned a Ford car dealership and some real estate, and Mr. Bondi put the real estate in a separate entity, and then he spun it off, and the IRS determined that it did qualify for tax-free treatment, that there was a valid corporate business purpose because that was namely to preserve the dealership as the centerpiece of the reorganization, because Ford was telling Mr. Bondi that they didn't want the real estate mixed in with the dealership. Then we have another example here where it doesn't qualify because for tax-free treatment, because the reason the division or spin-off was done was to be able to spin off the controlled entity and make an S corporation election. Well, that's a tax reason that does not qualify as a valid corporate business reason. Same thing here. This was done to save on state income taxes. That is not a valid corporate business purpose. Then we have another example where there's a key employee who they want to give an interest in one of the entities, typically the controlled entity, and that does qualify for as a valid business purpose to give stock to a key employee so that the controlled entity, the business of the controlled entity will flourish. And let's see, this is, this refers to the language that even though you might have a valid business purpose for dropping down a business into a controlled entity, if that business purpose is satisfied by simply segregating it in the controlled entity, but there is no separate business purpose for actually spinning it off, then you can't spin it off. Such as like asset protection, protecting one business from the liabilities of another. Or even if there's just another way to do it that wouldn't be impractical or unduly expensive, well, then again, you will not qualify for a tax-free treatment under 355, but there's another option that can be done. This is the example that I mentioned before of a business which involves toys and the sale of candy. And again, they wanted to protect it from the liabilities, one business from the other, and they did not qualify for 355 because you could drop it down and segregate the liabilities into a subsidiary, but there was no valid business purpose for doing a spinoff. So here's another example. This is a regulated business, and so it has to do with regulatory reasons for doing qualifying. It has a valid corporate business purpose for doing the tax-free spinoff. Yeah, these are, I'm not going to spend time on this. This gets a little more complicated. But as you can see, there are many, many examples, and the regs go on at length about business purpose and also about the device test. So this is the rules and the regs about when is something a device and when isn't it, and it's all based on facts and circumstances. This is about the continuity of interest requirement. Basically, you should the owner or one of the owners of the distributing entity should retain 50% interest in the spun off or split off entity. And there's examples here again, which will help in understanding how the rules apply. And well, I can go on ad infinitum. I think I need to get to the end here. Here's the regs on device for distribution of earnings and profits. And again, the test is whether it's principally as a device, and is it the transaction avoiding what would be otherwise dividends. And there's device and non-device factors, which are here highlighted in the regs. What are device factors? And a pro rata distribution would be considered to be a device factor, i.e. trying to bail out earnings as dividends. A subsequent sale or exchange of the stock after the spinoff, of course, would be indicative of a device. Anything that was even negotiations prior to the spinoff, even though it's not binding, would be indicative of a device. As you can see, there are numerous factors here as to whether something could be considered to be a device or not a device for bailing out earnings. And this is all a facts and circumstances analysis. And you can see, to the extent there's a larger amount of cash or other types of liquid assets, that would be a device factor. And it goes on and on. So now here's the non-device factors. So if there's a valid corporate business purpose, it's more likely not to be a device. But again, they look at all the factors related to that corporate business purpose. Whether the distributing entity is publicly traded, widely held, that's less likely to be a device. And again, here's some examples, which you can all take a look at. That's why I've attached it. So it just goes on, and I think I'm running out of time. I haven't even checked the time here.
Now we're just past the hour, Steve.
Okay, yeah, that's what I thought. I think
I was going to give you
we're
a 5
almost at the end, page 86. So I'll just quickly run through the rest of it. It's just about all the device regs and whether they, whether they have accumulated earnings and profits. That would be a factor in determining whether it's a device, and whether redemption is used as opposed. And then, the reporting requirements. So the regs have detailed regs on what you have to report to the IRS, both the distributing corporation and the controlled corporation when a tax-free spin off or split up is done. So one has to take a look at the reporting rules too. So that, I think, concludes the general overview of these numerous and some of them very complicated issues. So it's, as I said at the outset, C corporation rules are like a lobster pot. It's very easy to get in, very difficult to lie in, and very painful to get out. And when one has to be careful to not fall in any of these traps for the unwary when you try to qualify for Section 355, and yet inevitably, sooner or later, every C Corp is probably going to have to deal with 355.
All right, Steve. Well, thank you so much. There's one question in the Q&A. It just says, if you have multiple buildings, if a corporation has multiple buildings, can it split up by claiming each building as a separate business?
Yes, you can do a division of a business, both on a vertical line and a functional line. So if you were talking about, I'm sorry, was it office buildings or just real estate?
Yeah, it says a corporation owns multiple buildings. Can it split up by claiming each building as a separate business?
Yes, I think it can. It could drop down some of those properties into a subsidiary and spin them off. Even, yes.
Okay,
Now, of course, you have to meet all the tests, though. So what's the business purpose for doing that? You know, it's et cetera.
okay. All right, Steve. Well, I'm sure people, there's another question. How long would you recommend the SpinCos, what does it say? Sorry. How long would you recommend the SpinCos carry on ATOB post-spin?
Yeah, I know. So it's a good question. In other words, once the spinoff, assuming you comply with all these rules, and you do the spinoff, how long should the shareholder of the spinoff entity wait before it can sell the entity? And again, there's no hard and fast rule. Some people say, and there's some authority to this, so there's some cases where they waited as little as 2 years and they sold the spun off entity, and it was not considered to violate Section 355. But then there's cases where they have sold it more, quite a few years later, and the IRS did not accept an audit did not accept that it was a 355 transaction. So it does depend on all the facts and circumstances. If it can be clearly shown that there was no arrangement or plan to sell when the spin-off is done, and that the sale basically happened because of intervening changes in the economy or facts, the property appreciated or what have you, then it should be quite safe. But what time period, there's no hard and fast rule. 2 years is kind of a minimum, I would say.
All right, thanks, Steve. I'm sure if people have further follow-up questions, they can reach out to you by email, right? I would think people can reach out. Steve, is that okay?
Yeah, that'd be fine.
Okay. All right. Thank you so much, everybody, for attending. If you're interested in getting more involved in the tax section, we are having our next tax section meeting on March 17th from 8:30 a.m. to 9:30 a.m. Our regular meeting time is I believe it's the third Thursday of every month in the morning. We normally will be having programming on the first Thursday of the month, but we have a little deviation because BHBA is having NFT week. And so we'll be having a program on April 1st on the tax implications of acquiring, holding, and disposing of NFTs. So look out for that and please sign up. And I look forward to seeing you at future programming. Thank you so much for attending. And Steve, thank you so much for that very informative program. Really appreciate it. All right, everybody, have a wonderful rest of your day. Bye.